Let's talk about the markets in 3 minutes. And let's talk about what we're waiting for. We're waiting for the CPI print, aren't we? So it is quiet. We're heading towards that CPI reading. And I suppose what we're waiting for is that the reading on core and just how sticky that remains. And then, of course, what that does to the Fed's impulse and how likely rate hikes still are from the Fed. What are you watching out for?
Yeah, look, I think even if core CPI comes in line with expectations, it's still quite a high reading and won't let the Fed be complacent on inflation yet. And I actually think it's the core reading where there's the greatest risk of potentially getting an upside surprise today. So, you know, people sometimes trade in the short term off the headline number, but the Fed is going to be very, very worried about that core number. And I think that's going to entrench the dynamic going into the end of the year that the Fed will not want to show any hint of premature dovishness until they are forced to. And that means they're forced to by growth clearly slowing or some kind of financial crisis or sometimes accident happening, which means the Fed is going to continue to sound very, very hawkish. Now, that doesn't mean they won't ultimately be forced to cut rates at some point into next year, but they cannot explicitly entertain such ideas anytime soon.
Right, and there are a lot of different theories out there about where the Fed goes in that context, aren't there, Mark? We talked yesterday about how a new narrative is being sought when it comes to yields, and we're seeing this play out on Wall Street in terms of expectations of where the Fed goes. We've got Morgan Stanley, UBS talking about big cuts to come from the Fed. Goldman Sachs, more modest, a little later in terms of the timing of those cuts, and that's perhaps a little more in keeping with what the market is looking for. Is this divergence unusual, do you think?
I mean, we haven't had it in the last 15 years because we've had rates stuck near zero and nothing happened. But it was quite normal. And, you know, back pre-2008, this was completely usual, and we shouldn't kind of read too much into it. There are really two dynamics here you need to think about. There's whether a recession will come and the timing of when it will come, so kind of the growth story. And I'm in the camp that I think that we will go into a recession next year, and I think it might be harsher than people expect. And the other dynamic is the Fed's reaction function. Now, I would say while I'm probably more negative on growth than most people out there for 2024, I've been more optimistic than most people for 2023. I'm now more pessimistic than most people on the economy for 2024. I actually think that the Fed will not react the way some people think. So there are many people in markets who have been brought up in the last 15, 20 years, and again, this idea that the Fed immediately cuts in an absolute panic. The fact is that most of us, including myself, did not trade through a recession with an inflationary background. And I think in that environment, it makes sense for the Fed to be much more hesitant to cut rates. So including myself, we've all been brought up in a world where Fed reacts quickly. It's going to be more like the 70s or 80s where the Fed will not cut rates at the first sign of a growth slowdown. And that's why I think the Fed cuts will come later. How much they'll ultimately have to do will depend if something breaks in the financial system or depend if the recession is very deep. So I guess that mixture of those two inputs for me means I'm somewhere in the middle of the camp, boringly.